shots fired over the bow, the White House announcing that they are pushing for a national rent control regime with 5% caps on rent growth. Flies in the face of research, science, academia, capitalism, property rights. We're going to be pushing back on it because, again, it's not policy that we need for the United States. We're going to be getting into it today on the Gray Report, but also articles from BizNow on multifamily distress delinquency is picking up 185% increase. And then an article from Moody's looking at the skyrocketing multifamily expenses. You may not know it's more than just insurance. And then from RealPage, we're looking at improved rent growth, looking forward to 2025. Does that have to do with supply? Is it demand? We'll get into the details for a RealPage. Marks and Millichap as the Fed finally reached a tipping point that's going to go right along with the report from the Bureau of Labor and Statistics with their CPI print that took place just last week. All right, strap in. We've got a great report. I am reporting live on location from the Mediterranean. Matt, let's get into it. All right, welcome back to the report. Matt, how are we doing this week?
Pretty good. It's like some new exciting things. And there are so many times this week where some new reports came off or some new developments happened that were merely just mentioned in a tangent from last week. So I'm particularly excited to extend a couple of these discussions, particularly about, multifamily expenses, distress, and the idea, if probably not the possibility of rent control. I think it's just an idea, and I think it's going to stay that way.
I think this has something to do with the election, Matt.
I completely think yes. I think that it fits.
So?
Yeah, I think that it fits in the rhetoric in like a plank on on the campaign platform. But it's not a realistic thing. I think that you group this in with corporate inflation, like corporate greed. They're hiking up the prices, they're hiking up the rents. And so that's the category that it is. It'll be in speeches, but I don't think that it is going to be enshrined in law anytime soon.
I think that's a great point. And was, I would say, shocking that they actually came out and said it. It was not surprising in a sense that Biden has teased rent control numerous times recently.
Mm-hmm.
He did it in a speech. He did it. He also did it in the debate, saying that we're going to put a cap on rents. And when he said it, it almost seemed like a slip of the tongue of like he's just putting it out there. But it was so specific in a way that it couldn't be.
You're referencing when he said it during the debate. When he said it during the debate,
when he said it, he's like, and we're going to put a cap on rents. And I was like, what? Did he just say he was going to institute national rent control? And obviously there was confusion throughout the debate, so we'll forgive you for just saying something. But obviously it's on the top of their minds. But the White House economists, Matt, have pushed back on saying that rent control essentially doesn't work. Economists across political aisles have looked at the data and looked at markets. But what's your take? I'm curious.
Well, last week we covered an opinion piece from the president of the National Apartment Association, and I was like, wait, why is he writing this? It's because I bet that the White House administration probably called him and consulted with him about this rent control thing, and he knew about it.
Yeah, I'm sure they were like, don't you guys want to get behind this? It's not that big of a deal. Yeah. But Matt, you did some really interesting, just a little bit of sleuthing and just like did some really simple math. Simple math, not complicated. And to take us to the math, because it sounds like rent has grown more than if the cap would have been placed nationally. Yeah. And so what are we even solving for?
So the headline for the White House thing is he wants to make a 5% rent cap. And he says you can't raise rents more than 5% or you will lose your tax benefits, the kind of bonus depreciation that they currently enjoy. So I was like, all right, 5% rent cap. Let's take the 2020 from 2020 till now. Let's increase it by 5% every year. And let's just see where we are and compare it with actual rents. because that'll kind of prove it, right? So rents were at 1444 in 2020 Q1. Increase that by 5, you're at 1516 in 2021. Another 5%, you're at 1592 in 2022. You're at 1671 in 2023, and then in Q1 2024, you would be at $1,755.19, and the average rent right now, I'm sorry, in Q1 2024 was $1,675. So basically, we are at the 2023 rents. We're a lower rent than if you had that rule in place, basically. It's very shocking to see.
Are you saying that the market is actually essentially kind of doing the job or the objectives that the White House is pushing for, in a sense that it's lowering the rent on its own?
Yeah,
the market is speaking, and working to an extent.
No, I would phrase this, if I could speak to the liberal Biden administration, you could talk about it as, let these greedy corporate landlords build more apartments, and then you'll get the rents down, and their hubris will lead to lower rent growth. I don't know any other way to put it, but it really was like the free market did solve this problem. What happened was they saw a lot of rent growth in 2021, 2022, and then they built more apartments, and then suddenly the rent growth went down. No one forced them to do that, because in this case, if you're mandating the 5%, then you probably also have to mandate the apartment building. And we got there anyways. We got to a better place than if you just mandated the 5%. Now, what would have happened, actually, I think, is if there was a 5% rule in 2020, there would be no investment into apartments. Apartments would be stagnant. There would be not enough supply, and the rents would be locked in at that 5%. So that's not as attractive. So really we're getting, like, I don't want to say the best of both worlds, but we kind of are. Rents are lower, there's more apartment supply, and you don't have to make a rule about it that restricts people.
I also want to talk about some of the other parts of what they're proposing, not necessarily the specifics, because as you mentioned, Matt, when we were just getting ready to start this episode, none of this is like too extreme. It's not like they're saying that rents, have to be like frozen or anything. It's more just the fact of putting any sort of kind of price caps and limiting kind of just free market enterprise. And because the other part of this, what they're pushing for, and again, this is not an executive order, they're pushing for legislation in an election year, and none of this is ever probably going to happen. But the one thing that concerns me is that they're kind of bringing out this idea of using the FHFA, which is the Federal Housing Finance Agency. Fannie Mae, Freddie Mac, HUD is a part of that, and the majority of apartment loans on market rate, not subsidized, not affordable housing, but normal market rate apartment loans, are financed through the FHFA, because it's very attractive financing, because the federal government wants to encourage the investment and the development of housing in the United States. That's great. So what they're doing, though, and they've started earlier by inserting some sort of social policies into these financing, into these loans.
So like strings attached, kind of.
Exactly. And so they've typically done it with more carrots rather than a stick, though. And so what I've said, first it was green financing. So, Fannie, would offer, green financing options. And if you did certain things like, put in more water efficient plumbing fixtures, LED lightings, you get the idea. If you reduce your overall, energy usage, you would be able to get a better interest rate your loan. They also have a mission component. If you are targeting renters that fall within the mission, which is a certain percentage of the area median income, you are able to get better financing terms because you're serving a certain population. Now, obviously, some of that can be misdirected, because AMIs can be really high in some markets and low in others, and whether you're I think the apartment operators were installing LEDs and energy efficient utilities anyway. It certainly encouraged more activity, but we're, I guess, expanding the idea of using Fannie Mae, Freddie Mac, and HUD, via the FHFA to, drive an agenda. And nothing what they're proposing, which is what the new proposal is, they'd use the FHA to basically require landlords to provide 30-day note. Okay, just some preface. These are all things that are industry standard.
Yeah.
And you're right. It's not a big deal. It's just the fact that they're using it as a tool. And I think they're going to continue to use it as a tool. And I think that a better way for them to push forward rent control is going to be through these agencies and saying, you're going to be limited in rent if you want to take this really attractive financing. I would hope that they would continue with the carrot approach of saying, look, you don't have to do this, but if you do, we'll give you even better terms. Rather than if you don't, what they're proposing right now is if you own more than 50 units, if you're a corporate landlord, whatever that means.
Yeah.
If you're a corporate landlord, you own more than 50 units, we're not going to allow you to take all the bonus depreciation and the tax write-offs for that property. We're not going to allow you to reduce your taxable income. Which is insane because that's one of the reasons why people invest in real estate. So they're using the stick of saying, oh, you're going to increase rents a little too much, or we're going to slap you back and make you pay more taxes. I'm concerned that they're going to continue using the agencies as a tool. And, as an investor, I've always been, I guess, concerned because of this, knowing that the federal government obviously has their hands in it. And you are partnering with the government, and the government. I mean, they're the ones that have the monopoly on violence, Matt. They're going to be able to do whatever they want.
Yeah.
And so we're talking about new loans going forward, not changing loans that are currently in place. But it makes me concerned because these proposals do not promote more housing. And you said it exactly right. We need to build more housing. Whatever we need to have any conversations other than encouraging the building of more housing stock is just putting up flags, just political messaging.
I was particularly struck, and maybe this signals, and maybe this is why I thought, well, this is this is more of an abstract idea than a practical plan, because in previous documents from the Biden administration on housing, which we've covered, the rent control portion was either not mentioned or barely mentioned at all. And in this most recent press release or announcement or whatever, that takes the headline. Like, they wanted that to be foregrounded because I think that again, it is kind of a campaign thing that fits with, all right, corporate greed, inflation, corporate landlords, rent hikes. And the irony of it is that inflation also is gone. There's inflation. It is deflating. We'll cover that in just a few minutes here. But also rent growth is not a problem either. Rents have not grown in the past 2 years. And so why are we solving these problems that don't exist anymore and were resolved without government intervention? So it's confusing, and the only way it makes sense to me is as an idea and not as a actual plan. It makes me a little more optimistic.
Yeah, it's true. It's not something I'm not losing sleep over it right now, but it's definitely something that we don't like to see, like to hear, because again, it's unfortunate that we're making everything political, and we should just be, really following the science, following the data, and pursuing policies that actually work, and not something that just makes us feel good.
Agreed.
Let's move. I don't think there's anything else to say there, Matt.
Oh yeah.
Because again, I don't think it's not gonna happen. Other than that, our official stance is against. We are on the con side here. All right. According to BizNow, Matt, multifamily distress leaps 185% as delinquencies pile up. That's a big number, Matt. As we know, we're talking about, it's not as though there are hundreds of thousands or thousands of multifamily properties now being distressed. We're talking about changes in fractions of a percent, but it's a big increase. Break it down. What's going on with the multifamily capital markets?
Yeah, so BizNow had the article. They kind of had the scoop, I guess. But the source here is CredIQ, who has apartment distress up 185% in the last 6 months. On the one hand, that's 185%. That's a big number. But what we're really looking at, and I'm scrolling down here for the actual good chart here, is the growth in these loan delinquencies in the multifamily space from 3%, where it was at January 2024, to all the way up to, what is it, 7.4% now. So that 3%, 3.4% increase is actually kind of meaningful. And I think that like I don't have the multifamily specific data as a whole, but this chart for overall CRE shows how it is delinquencies that are increasing, that have been increasing since the beginning of the year. And there has been a plateau in special servicing. I don't know if that means that if special servicing is like loan extensions and accommodations, I don't know how that overlaps with just like, all right, here's your first warning. But my, the way that I'm framing this, at least personally, is, well, it looks like there is a breaking point here. And people that have gotten these, there's special conditions, we're waiting, or we'll work this out. And now it's, no, you're not, you're missing something. Either the borrowers are unable to pay or unable to make whatever special servicing requirements there are, or the banks themselves are like, okay, your grace period has extended. We also have money that we need to make, and time's up. I think that's particularly relevant in an environment where expenses are high too. And we'll get to this in a second here, but you've got low rent, which we just have talked about. You've got this pressure that is not going to go away, even if there's a little tiny rate cut in the future. It's not going to go away for borrowers. So you got expenses, rents, and now this and continued borrowing pressure. I feel like, now I'm not expecting the multifamily investment market to be littered with great buying opportunities for the taking, but I think that the aggregate effect of this increase will be of this increase, in delinquencies and distress, will be more sales activity in a multifamily market that has really been cold and quiet and really in dire need of activity. That's what I'm thinking. And last week we talked about how the prices of multifamily properties increased 4.9% in the past month. I think that is a sign of increasing activity in a place, in an environment where there really aren't a whole lot of sales opportunities compared to, say 2022. But again, it does seem like things are primed to heat up. And I know that it's not going to improve existing borrowers if rate cuts happen, but if rate cuts do happen, I think that it will get buyers excited and maybe willing to buy it, and that will just kind of continue.
There is certainly a for distress out there. If the investors are kind of frothing at the mouth. I saw a post on LinkedIn. Somebody was saying that buyers are saying that they're not going to be willing to purchase an asset less the seller, if the seller is making money. They have to be losing money for the buy, regardless of if it's a dealer. But if they know that if the seller is getting out with something, to them that's not a good deal because it's not distressed enough.
Okay.
That seems really short-sighted.
Yeah, I agree.
But it reminds me. It reminds me of kind of early 2020, mid 2020, when everyone was waiting for the COVID discounts to occur, and they were like, "No, there's going to have to be a COVID discount," and those obviously never happened. Now, there's an argument to be made that some of those folks were smart because they didn't overpay on assets in 21 or 2022. But Matt, very well that there was a great opportunity to acquire assets before the run up in 2020, which we were able to take advantage of at great capital. And even picked up some assets in 2021 at pretty decent prices. And to me, it seems like a mentality of, and again, I mean no offense here to anyone, but a little bit more of like a boomer mentality of believing that they have seen this all before. And while history certainly rhymes time and time again, we're in a pretty unique environment right now.
Yeah.
And the fundamentals are just too strong. And there is a floor in this market. There is a bid for multifamily assets that are cash flowing, especially if they're high quality. Now, I think the big concern and where the correction, and I think this is natural and necessary, are in more of your kind of C and B class assets, properties that were built prior to the 90s, that are very difficult to insure right now. with tenant resident populations that are having a harder time, maybe paying their rent, even though their wages are growing. Rent still had increased quite a bit, and the expenses of everything else have gone up. There's not nearly as much interest in those types of assets. People are trying to trade up by newer, higher quality assets and better locations. Tons of demand for that. But so there is a bid, but unless you're willing, but no one wants to buy the older kind of your classic value add workforce housing deals because they're more challenging to finance, they're more challenging to manage, and people could get over that, but the insurance aspect also makes it incredibly difficult. Insurers don't want to insure it. And so what needs to happen, and I think is going to happen over time, is you're not going to see a big price decline. I don't think we're going to see much more price declines for good B class and A class assets, like B plus and up. But I think you are going to see some further price declines in older vintage assets, 60s, 70s, 80s vintage deals. They're just because there's not going to be, unless they're really good quality in a good location. If you're buying something that it's rough, and where 5 years ago it had been an ideal, or 5+ years ago, ideal value add opportunity, you're just not going to be able to get the insurance. I mean, the insurance has doubled, tripled in many cases. We're going to get into it. It's not the only expense that has increased over time. Those prices probably should correct a little more, and where we see cap rates higher, because we were living in an environment for a long time where cap rates and it's different business strategies. So there are some nuances, but you're buying a brand new or nearly new property for a 5 cap, but also the value add deal was built in the 70s. It's also a 5 cap. Why would I buy in place cash flow, same cash flow for the value add than the class A? The idea is that you can force appreciation by spending money, fixing up the units, and increasing rents on the workforce housing project, so you can get to an in place 7, 8 cap. But the reality is you often can get some decent rent growth out of the A class deal. So even if you're not able to get the full rent increase, it's still a pretty damn good value for buying something that's new, that's gonna not be falling apart as quickly. A tenant base that's gonna pay on time, slightly easier to manage. So there should be a cap rate differential between something that's harder to manage, it's going to be more work, and has higher risk. That's what it comes down to. But we were that, but that kind of evaporated in the run up to the peak of the cycle. So I think it's a welcome change. And we do see some further cap rate expansion, workforce housing, A class, well located.
That would give,
those prices are going up.
Well, and if you get cap rate extension, then on the kind of 1970s, 1980s, if they're cheaper, then that would give buyers more room to make improvements that may be mandated by insurance, or at least that would result in insurance getting lower.
Well, that's what I'm saying. It'll all work. That's the only thing that will make it all work. Because right now it's like this, the math doesn't work. But if the price comes down, it can work, because then you can pay the expensive insurance and you can afford to do the repairs that are necessary, because you're getting it at a low enough basis. But you haven't been able to get it at a low enough basis because they were just trading at such a premium.
I have a question too, is that, and now there's natural wear and tear, but is there also like aspects of these older buildings that are like expensive to make? These ones lack features X, Y, and Z, which are really important for insurance. But if they're built after 1985 or whatever, then they have these features, and you don't have to spend a whole lot of money to improve them. Is there things about older properties that are just like more expensive to bring up to code, or is it all wear and tear?
No, that's a really good point. Specifically, I think what you're getting at is the sprinkler systems. Insurers, they'll ask, they're like, all right, is the property sprinkled? Well, no, it's not. And then they say, okay, well, maybe we can't even insure this property. Whereas that wasn't a big deal a couple of years ago. It was nice to have a sprinkler system. I mean, obviously, there's maintenance, and the dry systems can be expensive to repair and maintain sometimes. But now insurers, often, again, they won't even insure some properties that don't have a sprinkler system, that don't have a fire control system. So in installing one, again, you have to buy it at such a low basis to be able to afford to do a CapEx project, because renters do not care whether the property is sprinkled or not.
Yeah. And it is interesting then that so there was maybe like building codes that that allowed these buildings to be built without sprinklers, and now or is it just kind of a standard, just like industry standard that is that the newer ones are built with sprinklers?
It's more of a code. I mean, every
Okay. Yep.
municipality is
Yep.
different, but yeah, I think it's more of a
Yep.
code thing.
Okay.
Yeah.
Interesting. Well, that's just one expense.
Yeah. Well,
Here,
what other expenses are there?
Yeah, so we've got it's not all insurance. That's the headline to this Moody's Analytics article. As we noted multiple times before, again, you got high interest rates, you got low rent growth, and now we've got these expenses. And I'm going to scroll all the way down to what I think is the most telling chart here. And they are comparing with two different shades of blue. The dark blue is the expense growth from these different categories in 2010 to 2020, so like 10 years, and then maybe the 2 or 3 years from 2021 to 2023. On the left, you got your 10 years. On the right, you got your 3 years. The pandemic era expense growth was double or often triple the expense growth in the 10 years of pre-pandemic. That's like if you're going year over year, that's like 6 times the growth rate of pre-pandemic for some of these things, if not more. It's ridiculous, and it's very telling that like I don't know, it just tells the story in and of itself. I can say the expenses have grown, and you look at this chart though, and you see how much things have gone hand over fist.
This is the type of data that, the flies in the face of, the Biden administration and the piece of the White House. And specifically, they said that, landlords have been raising rents, more than their costs have gone up. Well, one, that's the whole point, is that your rent of price growth is more than your expense growth. Otherwise, you go into the negative. Again, it's like really simple math. But you'd look at saying the last couple of years, take the last, 18 months out, but since the pandemic, we've seen incredible amount of rent growth. 20, 30% rent growth in some years. Landlords should be making money hand over fist. But that's like obviously not the case. And certainly doesn't feel that way. I mean, properties are doing, pretty well, but it's not like if you told me, well, what if we could increase the rents of your property by 20 or 30%? Of course, you look at just in a spreadsheet, you're going to be cash flowing, double digits, but that's not what's happened at all. I mean, cash flows, again, they're still, they're steady, but they're much lower than they would have been if expenses haven't also risen. Again, it's not just insurance, it's payroll, it's turn costs.
Oh yeah.
Every contract service, every, contractor that you work with.
Professional fees.
2021 and 2022, they decided, hey, you know what? We have to increase our rates also. So they were getting hit every which way: utilities, energy, taxes, insurance, payroll.
Just to run through, they have these categories here, and they have the dollar amount per unit, how much the increase was, and then they look at the percentage of increase, which I think is a little bit more useful. So utilities increased by 7%. And we talk about it, property insurance, and for the amount that is very high at about 9 or 10%, but not far behind that is repairs and repairs and maintenance at 8% in growth in just a year, and utilities at 7% growth in just a year. Those are huge. And guess what rent growth was? Not 7, not 8%, very much closer, like 1%. So the fact that these are growing is not good, especially for people that may have bought when the rents had already peaked. And that's not out of the question that happened, where someone had bought in maybe late 2022 or early 2023, and they didn't have a plan. They weren't really thinking that expenses would grow. Well, they're not seeing any rent growth, and they just got a negative after negative. So that's what it creates that horrible situation for people. And then what if they had we're talking about floating rate debt, and you could get caught on. There are a small group of probably very distressed people at this moment who maybe didn't enjoy a lot of rent growth, got on the wrong side of a floating rate loan, and have these expenses to deal with.
Texas and Florida. That was the big thing about Austin. A lot of investors, they have Texas and Florida focused in both of those states. not every market in those states, but many of those markets, Austin specifically, has been, again, ton of growth in both states, which made sense for the investment thesis.
Mhm.
But everybody had the same idea. It was an overplayed thesis, and
Yeah.
they built way too much in Austin. Yeah, are there tons of people moving there? Are there tons of thousands of jobs? Yes. But you built about 5 times the amount of apartments they need in a single year. They will be
Mhm.
absorbed over time, but you're seeing 7% negative rent growth. And that scenario that you described, Matt, of someone buying at the peak pricing in 2020, the end of 2021, early 2022, on a floating rate loan that's starting at 0% interest rate, that definitely happened a lot because everyone was trying to get into Austin, Texas, trying to get that growth. They said, "Oh, look, they just signed a lease or 10 leases and a 30% increase. We're going to
Mhm.
increase the rest of these rents by 30%." But what happened? Rents actually decreased by 7% or
Yeah.
10%, while their debt service tripled and their insurance doubled, and
Mhm.
the utilities increased by 7%, payroll increased. That it just, again, we come back to the math. The numbers don't work, and those properties, many have already been handed back to the bank. Others will follow.
Yeah. The buyers in this case are losers, and nominally they made kind of an educated guess and projection on where they thought the market was moving, and obviously we are optimistic on the long term benefits of multifamily, but this volatility, this very volatility that you describe, the greed or the optimism or whatever, that allowed more apartments to be built, and that's a perfect counter to the Biden rent control plan. It's like, we're out there being driven by greed or hubris or whatever you call it. There are winners and losers here, and you don't need to make everyone a loser by forcing them, restricting what they can do. So it's up and down, and that's the way it should be. That means the market's kind of responding to things.
Looking at
Yeah.
outside of 2024, 2025,
Yeah,
Real
perfect.
Page has a little bit of a forecast pointing to some improved rent growth. What's the story there?
All right. So this article from RealPage is it's brief. It's a little bit of a forecast. It's different, I think, than some of the other forecasts that we get, which is just like an average. This one is, what do they say? They have kind of a weird way of putting it. They say that their most recent forecast indicates that 50% of the top 50 markets should see annual rent growth between 2 and 3% in calendar year 2024. I'll be honest, like, that's a little bit vague. I just want a straight up average. What do you think the rent growth average is going to be? But the way they slice and dice it, it's okay. What I think my bottom line understanding of this is that in 2025 they expect a return to normal. Basically, we may not get to the typical pre-pandemic rent growth in 2024, but 2025 is probably when we will get there. I liked their chart of supply, which I'm showing here, and it shows that they're expecting by like Q4 2024, they're expecting supply and demand to more or less be equivalent. And then as it rolls into 2025, all 4 quarters, they're expecting annual demand to surpass supply, which is very promising, and I think could get us to a place where there is, I think, above average rent growth. And I don't think that's an outlandish expectation given the fact that we have had so little rent growth, and there's maybe room to grow because of the last 2 years of stagnation in the rental market. But in terms of specifics, the quote here is approximately, so this is their 2025 projection. They say that approximately 40% of the top 50 markets could experience annual rent growth of more than 3%. About 55% of the markets are expected to see rents grow between 2 and 3, and that's compared to a 50% for 2024. So we're talking about a 5% improvement in that. And then they said a little over 5% could see growth below 2% in 2025. So not so bad compared to so they have that 5% number with super low rent growth, and this year they're thinking that 24% will have that kind of super low rent growth between 1 and 2, and then 18% they say could see growth below 1%. That's for 2024. So it looks like the biggest gains, so to speak, will be among poor performing in terms of rent growth markets for 2024 they're really going to jump up and return to normal a lot in 2025, and then the higher performing ones will see less of a boost, which is kind of to be expected as the market bounces back.
Doesn't look like we're going to see the massive jump in rent growth. Right? I don't think anyone really would want to project that, but more kind of again return to normalcy and steady growth by the time we get to 2025.
Yeah, and that is in line with kind of our own expectations and what you've said before, Spencer. And you kind of called this like maybe 2 years ago when we were projecting out what the interest rates and multifamily construction activity would look like. It was in 2026 where people would really start to feel the effects of lower apartment completions, of less new apartments being built during the high interest rate period, and that looks like it's going to happen as 2025. We're still coming off this huge supply wave, but I'll be honest, I'm very encouraged by the amount of multifamily demand that they're expecting. I see, I went on CoStar and I looked at their multifamily supply projections, and it's roughly the same. I think a lot of those are the same, but to have this demand projection from RealPage here is an interesting note, and I think it shows a little bit of optimism that I'm willing to accept.
I think, if you want to get an opinion, look at the people who don't necessarily have a dog in the fight in terms of like their investments or raising money or they're selling, deals. The folks, like Jay Parsons or Carl Whitaker, or Chris Salviati, folks that, are just looking at the data. Yeah. And, the conclusions are pretty clear. The fundamentals are really strong. There's a ton of demand. Mm-hmm. Things are actually looking really good for multifamily. Obviously, we got to get through the supply wave and the capital markets issues. But it's the less informed or the folks that I think are having a delayed reaction. Like I'm getting here people that are now bringing up loan maturities, Matt, and I'm like, yeah, we put that report out over a year ago.
Yeah,
over a year ago, and now you're learning about it. And so I think that then they're saying, well, there's going to be, declines. And I'm like, okay, well, the market's already declined 20 to 30%. You're seeing an additional 20 to 30% based on what? Based on the fact that KKR and Blackstone have deployed billions of dollars in the last couple of months. Essentially call the bottom. The fact that Green Street's called the bottom, that every data firm is essentially saying that, demand is stronger than it has been in decades, and supply is narrowing.
Yeah,
I don't know. Again, we don't want to ever think that we have it all figured out, and we certainly don't. But kind of the general direction, I think, is somewhat clear.
Yeah, I agree. I think it's interesting how, we think of long-term investments in multifamily and how it rewards, this is it's not like a thing where things change on a dime necessarily, especially compared to the stock markets, like highly reactive, but it does reward thinking ahead. But at the same time, sometimes we come upon an idea and we are thinking ahead, we're thinking fast, and we're reacting to the implications of things that we have to wait a year for to actually realize. Like we were on this low maturities, and it's true. I think the people that are still thinking of low maturities, they're still right. It's just that we've been ramped up for this for a year, and we're still waiting. But without that ability to kind of gear up and get ready to strike, you can't. It's like what you said last year, or I'm sorry, last week. It's like you buy once it reaches the mainstream, it's already old news. There are people that are willing to act, and the length of time it takes to complete a multifamily deal sometimes means that the market has changed out from under you after, in the moments it takes to close.
Buy the rumor, sell the news.
Yeah, that's what it is.
It's that's all it is. It's trading, investing, kind of basics. If you're trying to get in once, the Wall Street Journal's already figured it out, well, you're going to be a little bit late to the game.
Yeah. Let's speculate some
Marcus
more.
Millichap, Matt. Let's speculate some more. Marcus Millichap, has the Fed finally reached a tipping point? This is on top of the CPI print. So pretty good print for inflation, Matt. What are we thinking? When are interest rates going to be cut?
I am disappointed that we recorded last week's episode of the Gray Report a day before the CPI came in. CPI showing deflation. Last week we were even talking about, as I was mentioning some comments from Jerome Powell that seemed to kind of clear the way for a potential rate cut after these people are careful with their words and their announcements. And you hear since March, I've been hearing equal parts, we got to remain hawkish. There is a rogue Fed that's like, well, we could even raise rates. And there was little around the spring, there was little idea that there would be a rate cut. And now that we're seeing deflation, that we're seeing prices actually go down 0.01%. I think that that's very promising. And there was another Federal Reserve governor that said recently, maybe it was this morning or yesterday, put out comments that said, yeah, well, we're getting closer to a rate cut. And the fact that they're saying they're closer means that they're not worried about an overreaction from the market to the rate cut. They're more worried, and I kind of am too, about the slow boat that is the economy. And right. So this is where I think that Federal Reserve gets a little bit of unfair criticism, because they could institute a rate cut in September. The economy could get worse after that because rates will still be high, and things may get worse and worse as interest rates continue to get better and better, just because of the drag and the lag of the economy in reacting to lower interest rates. So all that being said, that's what I think is making the Federal Reserve at least more amenable to the idea of rate cuts, is because now they're looking at the potential for maybe a mini recession or a downturn. Because I think jobs numbers, if they continue the way that they're trending, it's not good news. Consumer spending has been actually, I've gotten some recent news that it's been relatively positive, but it's not like going gangbusters like it was before. And you need only look at the inflation numbers to see that things are trending down. To pull out the inflation number specifically, I just want to pull out a couple numbers here. Let me share my screen here really quick. I will highlight shelter of the rent of primary residence, which finally has gone from 0.3 inflation to has gone from 0.4 monthly inflation to 0.3. There we are here.
Oh, thank you.
Wait.
Thank you for finally bringing shelter costs down.
Yeah, I know. That's what I spoke it into being. I was incorrect here. Rent of primary residence didn't go from 0.4 to 0.3. It went from 0.4 to 0.2%. That's really promising. that means that if you kind of annualize this, it's closer to 2.5% rent, maybe 3%. I don't know if you're compounding. I don't know, but
it's happening.
Yeah, it's happening. This means now, if I were to be tricky and use that same way of math of that 185%, I could say that rent of primary residence has decreased by 50%.
I was thinking the same thing.
So we got a 50%.
We should use that. Send that to the Biden administration.
Yeah, that's right.
And this is what we've been waiting for. This is what economists have been waiting for. This is what the Federal Reserve has been waiting for, is movement in shelter. I think this is going to give them now the trajectory. It's not going to be right away. And they're going to be more confident that on future CPI prints, because again, the past is prologue, and we know that from higher frequency market rate information, the direction of rents that have taken place over the last 18 months, CPI is lagging at least by 18 months. And so assuming that the CPI shelter component trends follows a similar path that market rate rents followed, we're going to see continuing declines. And we're just waiting for that to finally start getting into the system, finding its way into the data for actually to make some conclusions. Really good point you made earlier, though, Matt, is that while this is good news generally for the trajectory, it's not as though we're out of the woods, whether it's September or it's January or whenever it is, because most likely, unless we do see a big recession all of a sudden, it's not like rates are coming back down to zero. They're not coming down that much. Maybe they're coming down 25 basis points. And so if you're hurting right now, that 25 basis point decrease is going to be better than an increase or staying where it was, but it's not going to solve all of your problems. And it's most likely kind of a slow move, being data dependent, seeing if the economy really does slow down, or if it kind of stays on a current its current pace. And again, I think we're still getting out of the shock of the pandemic and in a little bit of an unprecedented scenario of where the cycle, the timing of the cycle, the periods of the cycle have been compressed and expanded at intervals we're just not familiar with. And so we're not out of the woods just because rates decrease. I think that we're seeing that is like the first glimpses of light, and that now we're seeing the clouds parting the sky and the stars emerging. And so where Jerome Powell saying, we navigate under the stars.
Yeah.
Those clouds are beginning to break, and we're getting glimpses of certain stars. We're not seeing the full sky right now, but we do see light coming in, and we're getting our bearings and our heading, looking at where we've been, giving a good sense generally of where we're going.
And there is a chance that we're seeing a little bit of a mirage here, because there is the majority. I think the big driver of the decline in prices overall was from energy, specifically gas prices. So energy overall was down 2%. So that was a negative 2% in just a month, while gas prices were negative 3.8% in just a month. Outside of that, I'm guessing you'd be maybe flat on inflation, but there was there was nothing that was that strong in the opposite direction to swing it on the other way.
And seasonally, we should see, like rents, this is when we see a lot of growth in the economy. Typically,
good point.
Energy prices are typically up. And so the fact that we're seeing softer growth right now during the summer months is a sign. Again, I'm not going to be to say that like it's an absolute bad sign for the economy slowing down, because I think we are just doing some reverting and reverting to to the mean a little bit. I'm not inherently needing a recession. I don't think it would hurt to probably have a recession at some point, but I don't necessarily think that we need one either.
That's just what I was thinking when I was kind of processing all this. And like, yes, it is good news that we're in this place. And I see all these articles about soft landing, but it seems to me much more likely that as we are landing the plane, however it lands, it's going to be tough times for people, because a decline in inflation means lower economic activity. And there are some pains, especially like in the job market. And maybe I go to the wrong message boards, but all of the chatter that I hear about like people and jobs and like it's all complaints. Like people aren't hiring. There's a lot of people firing, especially in the tech industry. I keep reading stories of all these layoffs from these huge companies. Tens of thousands of people are being laid off and replaced by one robot or something. But I don't think it's all AI driven. And also, you kind of wonder about the bifurcation in, I guess the stock market, and how, AI is carrying forward a lot of the growth in the economy right now. And apart from that, how much growth has there been? Well,
is it the stock market or the economy, you think?
I think that's what I meant, like the stock market, because you get your Nvidias and those kind of similar AI stocks are the bulk of this S&P growth, and maybe not the other way around.
Big Chad, I think that we're starting to see how AI can play a massive role in the future, but I don't think it's at a point where it's practically moving the needle for productivity.
I mean, that was my point in just kind of illustrating. Like, I think that there are kind of cracks, and the cracks may be in companies that are like, all right, well, we're relying on AI, but there are limits to what it can do. It's not going to get us out. And that was my basic point, is like, AI is not going to get us out of this mess or whatever kind of cleanup that we have to do to get the economy back to normal.
I think that it will affect, if it hasn't already affected everybody's lives. And I mean, we're using it in multifamily, on the leasing side, on the marketing side, in limited ways, proprietary ways, but I use it all the time. Especially, I found it to be the absolute best travel companion.
Oh yeah,
travel guide. It's but it's not perfect. Now that I'm getting great information, but like the ChatGPT domain app, like sometimes it just it glitches out. It doesn't work as good as it should. But I've used it for where should I go, what should I do, planning itineraries, and doing real research with actual real results that are actionable. You still have to verify a lot of it. But it's incredibly useful. I mean, I planned a whole dinner, a whole day yesterday, saying, this is kind of generally what we want to do. Point me in the right direction. No, not something that touristy, a little bit different. They had a great day. We had went to a market, had a big dinner, all to the help of ChatGPT, made the recipe, tweaked the recipe with it. But then I see like some of my family members, like I'm here with my brother and my wife and kids, and some other, like my brother will be using ChatGPT, and he does prompting differently, and I'm like, hey, you got to prompt it differently. So there is like a little bit of a skill to get it to do what you want and use it effectively, and you kind of have to know how it works to really take advantage of it. It's like, don't ask it that, or don't ask it that way, because it's an LLM. It's not a real like person. It can infer some things, but you got to be a little bit more specific and tell it what to do. But it'll be fascinating. It affects the economy over the next couple of years, because absolutely, Matt, the stock market is being driven by kind of AI hype. A lot of it's real, but there is just some hype out there. Not all of it's real, but it's got some.
Well, that's why I'm glad I'm in multifamily.
Right, 100%. Yeah, exactly. People always need a place to live. Matt, this is a great episode. I appreciate you putting together. Excellent job on the production side. And we'll catch you next week. And make sure you're subscribed to the Gray Capital YouTube channel. That way you can get every single episode of the Gray Report. We bring these episodes at least once a week with special interviews with industry experts. Also, unique video content covering real deals, the way we look at it, the process, the team, the whole kit and caboodle. Hop on to graycapitalllc.com. You can sign up for our newsletter. Check out our latest deals and opportunities. Unfortunately, we're fully subscribed for our next multifamily acquisition in Indianapolis, Solana at the Crossing, only open to accredited investors. But you can still go to solanaindy.com, fill out the form, get on a wait list, and you will be informed of our next opportunity. So get in touch with us, whether it's on the YouTube channel or on the website. Matt, thanks again. Thanks for keeping things going over at the office. Indianapolis going well. Everybody's behaving and having a good time.
We're very happy. After that, once this raise was closed, we'll have to come back and celebrate with you.
Yeah, exactly. All right. Appreciate it, Matt. Okay. Talk to you soon. And thanks everyone for watching.
Thanks.